The OECD unveils gloomy new forecasts for the global economy, warning the world is heading for an economic slowdown. Mortgage holders are the most confident they've been about their finances for months. And get ready for a hot, dry summer. We are officially facing an El Nino weather pattern. Welcome to Fear and Greed Business News, Australia's best business podcast. It is Wednesday, the 20th of September, 2023. I'm Michael Thompson, and with Sean Aylmer still away for a little bit longer, I'm joined by Jennifer Duke. Jen, good morning.
Good morning, Michael.
Now, after the show, you have an interview coming up with the CEO of ANZ Worldline Payment Solutions, Peter Risker.
So we got really into talking about the future of digital payments, and that might actually be with a retina scan, a body scan, or even letting your car pay for you. Plenty of exciting ideas about what's possible in the future. So it's a good chat.
Yeah, it is. And ANZ Worldline Payment Solutions is a joint venture between ANZ, the bank, and one of the big payment providers globally. So it's a really interesting conversation with someone who knows this space so well. Now, the main story this morning, Jen, the OECD has released its newest global forecasts. And they're not particularly optimistic, are they? Warning that the world is heading for an economic slowdown.
Yeah, they're not optimistic at all. So global GDP growth is expected to remain subpar in 2023 at about 3% and get even worse in 2024 at 2.7%. Economies around the world are being held back at the moment due to rising interest rates to get inflation under control. Inflation is expected to moderate over the rest of this year and the next in many countries, but it's going to remain stubbornly higher than where we'd really want it to be. And this means that interest rates may be kept high across many OECD countries, though the report expects that most central banks are at or close to peak.
Now, as I often mention, you are in your day job, the economics correspondent for Capital Brief. So you'd be looking at this report and kind of seeing how it applies to us here. Did the report say much about Australia?
So there wasn't a change to the 2023 projections for Australia, but there was a slight 0.1 percentage point reduction for 2024. We're at a sluggish 1.8% growth forecast for 2023 and 1.3% for next year. Bear in mind that last year, the economy expanded 3.7% in real terms. And Treasurer Jim Chalmers said that the report shows the global economy is in an unpredictable place right now, and growth is going to slow considerably for the year ahead. Again, it's all about high interest rates, inflation, and also the slowdown in China hitting the global and local outlook. Chalmers said that the unemployment rate will likely increase, but the nation is in a solid position in the meantime and our exports are getting good prices. He also pointed out that the OECD stressed the importance of countries rebuilding their fiscal buffers so that they're in a position to respond effectively to future shocks, things like pandemics.
Now, Jen, obviously in an interconnected world, major economic changes, say abroad, can have huge impacts here on Australia. Looking at it from that perspective, are there any particular global trends pointed out by the OECD that are worth noting?
Definitely. So India's rapid GDP growth is worth keeping a really close eye on. So it's actually expected to continue outstripping all other economies in terms of growth in 23 and 24, as it did last year. And China also received an awful lot of focus. So the report actually ran several hypothetical scenarios to measure the impact of a possible slowdown in China on global growth. And what it found was that an unanticipated single-year decline of 3 percentage points in China's domestic demand could deliver a 0.6 percentage point hit to global GDP, and potentially even above 1 percentage point if there was a significant tightening of global financial conditions in response. And that's really massive if it actually ever happened.
Yeah, that is actually quite confronting. Now, what about outside of China?
So more broadly, it's clear that much of the world is facing really similar challenges right now. The climate transition, aging populations, rising defence costs, and higher debt levels than pre-pandemic. They're all the things that are concerning the OECD. And they're themes that we're really familiar with here in Australia. And the report actually summed up the challenges quite nicely. So it said, in the absence of adjustments to spending or increases in taxation, all these factors would imply significant future increases in government debt to GDP ratios. There's some really big challenges ahead. And that sounds to me like a little bit of a hint about tax reform.
Yeah, good summary of a really big report. How did local markets perform yesterday?
The S&P ASX 200 closed down 0.5% to 7,197 points. The majority of sectors fell over the day, with gold and energy performing best. The biggest falls were for metals and mining and materials. In terms of companies, gold and copper ore business Silver Lake Resources topped the list. It was up 5.1%, and it was followed by Western Australian gold producer Ramelius Resources, up 4.6%. The biggest fall was for semiconductor business Weebit Nano, which only recently joined the ASX 200, and it was down 8.9%.
Now, there's a fair bit happening on international markets. What's going on?
So, the Bank for International Settlements has included a new warning in its quarterly report about a buildup of leveraged short positions in US Treasury futures. The BIS said it is a financial vulnerability worth monitoring, and that's because it could trigger margin spirals and dislocate core fixed income markets. US Treasuries are a $25 trillion market, and rapid shifting of positions in times of crisis, such as during COVID, have resulted in really huge volatility. And also in the US, share buybacks have fallen to their lowest levels since the early days of the pandemic. So rising interest rates are making it much less attractive for companies right now to be buying their own shares. There's been a near 20% decline in the 3 months to June this year compared to the quarter before, and a similar double-digit drop compared to the year before that.
Now, anybody hanging out for cheaper petrol might be hanging out for a little bit longer, Jen.
That's right. There aren't any signs yet, unfortunately, of oil production cuts being lifted at the end of the extension period. So Saudi Arabia's energy minister says that the jury is still out on the world's economic recovery, and it's the data that's behind their decision to extend production and export cuts to the end of this year, not jacking up prices. But regardless, prices are pushing up towards $100 a barrel.
All right, there's a bit happening. We'll be back in a moment with the rest of the day's business news. Jen, the Bureau of Meteorology has formally declared an El Nino weather pattern, which means a hotter than average year and hotter than we've had for 3 years.
Yeah, it's interesting because a recent note from our regular guest, Diana Musina from AMP, said that the effects of El Nino on inflation aren't very clear-cut, but it could mean that higher Australian agricultural prices are seen over the next 3 to 6 months. Other weather bureaus globally have been announcing an El Nino year, though, so this isn't a really big surprise to markets, but it does mean a bigger risk of bushfires this summer.
Yeah, we have known that this was coming, but it is still a pretty big concern now that it has been officially announced.
It's a worry. It really is a worry. None of us want to see another fire season.
Yeah, certainly not. Now, investors have been warned that their dividends might be a casualty of the Albanese government's industrial relations changes. That is the message from the nation's biggest business, BHP.
BHP is actually saying that the closing loopholes changes to the Fair Work Act would hit the business by $1.3 billion. And this is specifically due to same job, same pay rules. And that would make sure that workers employed under different structures get paid the same as their colleagues on other agreements. Now, BHP hires about 4,500 people through operations services subsidiaries with typically lower pay than its mine-owning subsidiaries. And BHP says that this means a direct hit to shareholders because it will flow into dividends, or about a hit of 30 cents on a dividend payout potentially. BHP has made no secret that it wants to mobilise its giant 17 million shareholder strong base against these rules, and this includes many Australians via their super funds.
Wow, 17 million is just so many people. I know that you made that point that a lot of that is through people's super funds, but also individual direct investors. That is a significant number of Aussie investors.
It's a lot of people who want their dividend payout, so it's probably something the government will be a little bit nervous about to see how the public responds to that.
Yeah, good point. Now, tens of thousands of Australian investors joined the, quote, established affluent ranks last year with a net worth of $2.5 to $10 million, excluding the family home and superannuation.
It's pretty rich. So a report from Investment Trends estimates that 45,000 people moved into this group of investors in 2022. And there is also the emerging affluent group with $1 million to $2.5 million. And the number of affluent investors is now at 635,000 with a collective $3 trillion in assets. And those who are in the established group usually have a large portion of their wealth in property and equities. This doesn't even include ultra high net worth investors with $10 million or more to their name. And interestingly, those that fall in this mega wealthy category have an average age of 70, and more than half of them are or were either a business executive, an engineer, or a medical doctor. We're all in the wrong careers, I think.
I think we might have made some bad decisions earlier in our lives, Jen. It's not too late. So it's like how I always think that that it's not too late to become like a professional tennis player. And I realized that it was always too late to become a professional tennis player because you actually need that base level of skill. It's just something that I've always kind of clung to, that there was always that hope for me. And I've just only recently come to accept that no, there is no hope.
I feel like you have enough other accomplishments to not be too hurt about that.
Yeah, I know, but I just really wanted to be a pro tennis player. Anyway, just enough about me. Unions are gearing up to strike at Queensland's Kogan Creek generator, which is one of the biggest in the state, and they are warning It could lead to outages. Now, this particular generator supplies 10% of Queensland's power, and it's also relied on in northern New South Wales as well.
That's right. The Mining and Energy Union is preparing for industrial action from tomorrow and say it could lead to statewide pressure on the grid. Temperatures in Brisbane are set to jump to about 33 degrees tomorrow, and the initial action will include specific bans on working at heights or in confined spaces, but it could escalate unless agreements are reached. And the union told the Financial Review that this could mean running power stations flat out without scaling it back when wholesale power prices fall, or running it at a reduced rate during peak periods. The union's seeking guarantees that they won't be replaced by contractors, as well as attraction and retention provisions to be fairly distributed.
Now, we've just talked about how it's going to be a hot, hot summer. This could be very serious if this rolls on into those summer weeks.
Yeah, it could be really bad news indeed, particularly if there are some heat waves. And plant owner CS Energy says that it's negotiating in good faith with the unions, that it's made a generous offer to workers, and that it has plans in place to mitigate any impacts on power generation.
All right, now a bit of good news, Jen. Consumer confidence is improving rapidly for mortgage holders. The latest ANZ Roy Morgan Consumer Confidence Index is showing some green shoots for the economy.
So overall, there was a solid 2.2-point lift in the index, which ANZ is describing as baby steps towards improvement. Now, most interestingly, there was a significant jump up for mortgage holders, as you mentioned, to their best reading in over 7 months. This is clearly due to talk of interest rates stabilising and potential cuts in 2024, but inflation expectations are also trending down. They're now at their lowest level since February 22, which was before the Russia-Ukraine war began. Overall, the index does remain pretty subdued compared to longer-term averages, but these are all good signs of early possible improvements.
Now, the Reserve Bank published its September meeting minutes yesterday. Homeowners have now hit a somewhat dubious new record, with mortgage payments at the highest proportion of household disposable income they've ever been.
So these meeting minutes collated a range of different data points and looked closely at mortgages in particular for obvious reasons. And it found that mortgages are now at 9.7% of household disposable income. And that's above previous estimated historical highs. And it's due to push even higher as fixed rate loans move on to higher rates. And the Reserve Bank board said that Australia's outstanding average mortgage rate is higher than several other peer economies, despite the actual rates being lower. And this is largely due to more Australians having variable rate loans and shorter fixed rate terms. Credit growth has also stabilised, with new housing loan commitments falling and housing loans generally at lower levels. The bank kept rates on hold at the last meeting, as we've discussed, but the minutes did point out that the board considered a rate rise. And the RBA is also increasingly concerned about the impacts of that slowdown in China on Australia's economic prospects, including a hit to exports and a fall in international students.
Now, the New South Wales government has unveiled its state budget. We've talked about this over the last couple of days. The jewel in the crown is a $2.2 billion housing package, and the acknowledgement in the budget papers of housing affordability issues across the nation's most expensive city, Sydney.
So out of these funds, $1.9 billion will go straight to infrastructure, and this is funded through some leftover money from the Restart New South Wales Fund, and there's going to be another $1.5 billion that will be through changes to infrastructure contributions from developers. An extra $300 million is going to government-owned Landcom to help develop just under 5,000 homes, of which 30% will be ring-fenced for affordable housing. And I was particularly interested to see a $5.6 million spend in the budget ring-fenced for artificial intelligence to deliver planning system efficiencies, which is kind of interesting.
Yeah, that is interesting. Is that the first time that we've kind of seen in budget papers references to using artificial intelligence?
That's a really good question. So I think there's been a little bit of discussion among the public service about it. I've spoken to a few different officials in the past about different ways that they're considering using it, but I've never seen it used for planning before. It was foreshadowed a little bit in some local media, but I haven't seen any sort of millions of dollars set aside for it in this type of use.
The future is officially here, Jen.
That's true. That is true.
Now, as we've previously foreshadowed, a new giant industry superannuation lobby group will soon be launched, representing 10 million members. It is going to be called the Super Members Council of Australia, and it kicks in from October 1.
So this new group is made up of super funds who were members of the Australian Institute of Trustees and Industry Super Australia, and together they hold over $1.4 trillion in assets. So it's a very powerful collective. Interim Chair Nicola Roxon said that the new group recognises that the nature of work and the workforce is changing, and so are retirement expectations, and that's sort of behind this shift. And they especially want to assist lower income workers. And the group's foundation funds include Australian Super, Aware Super, SEBA Super, HESTA, Host Plus, Australian Retirement Trust, Rest Super, and Uni Super. So it's a big group, and they're currently seeking a CEO.
Yeah, very, very powerful group. Now, last one before we get to international news, a quick one. Australians are flocking to the big four for banking. The largest proportion of people in 4 years are choosing the Commonwealth Bank, Westpac, ANZ or NAB, according to comparison website Finder.
So 8 out of 10 people are now banking with a major. That's according to Finder's Consumer Sentiment Tracker, and they've been measuring this category since 2019. This is the highest figure they've seen during this measurement period, and it's a pretty sharp rise that coincides with a time of financial uncertainty for households. And Finder's saying it might be due to the feeling of safety with the big banks and a sign of consumers getting more conservative with their cash. But all deposits in banks up to $250,000 are protected by the government, and that includes the smaller banks. And it's worth shopping around at the moment, with some savings accounts offering as much as 5.65% in interest, and the better deals tending to come from the smaller side of town.
All right, turning to international news now, and short sellers of US cannabis companies are, I guess you'd say, feeling the burn, Jen. That is horrible, isn't it? And I apologise. Shares in these, what they really call pot stocks, have been on a high over the past couple of months. Goodness me, I'm just on a roll here.
Pun Central is Pun Central. Yes, the short sellers are facing $105 million in losses in the past year, and that's due to cannabis companies performing strongly. But a report from S3 Partners shows they're still betting against them. So over the last 30 days, there's been an additional $91 million spent on the hopes that there's going to be falls of these pot stocks. The MJ Pure Play 100 Index, which is actually a measurement of cannabis stocks in the US and Canada, for those who aren't familiar with it, is up 18% so far for September, but they're down about 90% from late 2018 highs. And part of this volatility is because the US Drug Enforcement Administration is reviewing the classification that it puts on cannabis at the moment.
Now, Ukraine has filed a new complaint with the World Trade Organization over a grain dispute. Hungary, Poland, and Slovakia have chosen to keep unilateral bans on Ukrainian grain imports after EU restrictions ended.
So the European Commission lifted import bans on Ukraine's grain, including wheat, last week, under an agreement that Kyiv would limit any surges of imports into its EU neighbours. But the three countries think that Ukraine's grain would impact local farmers and so brought in their own bans, which goes against EU rules and ultimately challenges its authority. Ukraine is saying that it's of fundamental importance for them to prove that individual members of the EU cannot ban the import of their goods. It would seem that Germany, Spain and France all agree. They've lashed out at the other three nations for cherry-picking policies and being part-time supporters of war-stricken Ukraine. Spain is even suggesting the actions may be unlawful, and Ukraine is indicating that it might hit back with its own trade restrictions.
Okay, last story. Walt Disney Co. is in discussions to sell its Indian streaming and TV business, Disney Star, and it is attracting billionaires, Jen, to the Magic Castle to discuss an offer.
This would be a huge media deal in one of the world's fastest growing economies. Now, the details of this deal are quite patchy. Bloomberg is doing a lot of digging, but citing unnamed sources due to how private these high stakes discussions can be. And so far, it looks like billionaire Mukesh Ambani's Reliance Industries is one of the companies taking an interest. This deal could take many shapes. It might be that the entire Disney Star business gets sold off, some sort of pick and mix style arrangement with its streaming service Disney Plus Hotstar and other assets packaged up, and it could even be a joint venture sale with Disney continuing to stay involved, or it could all fall over. We'll have to wait and see.
Yeah, we will. All right, up next is the Fear and Greed Daily Interview. You're speaking with Peter Risker, who is the CEO of ANZ Worldline Payment Solutions.
Yeah, it was a really fascinating discussion. He was talking about how companies are competing on digital payments, but also the new ways that we might be shopping, including virtually through the metaverse and with influencers.
Yeah, it's a good chat. It's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And as well, Jen, today is Wednesday, which means there's a new episode of our sister podcast, How Do They Afford That?, which is all about making your money work a little bit harder for you. Today's episode is really a bit of a special one. It is essentially your superannuation health check. It is everything that you have ever wanted to know about getting your super in order, from the absolute basics of kind of how do you actually figure out what your super balance is, through to kind of how do you check your risk profile and see where your money is invested? How do you change it if you need to? How do you make sure you've got enough insurance all through your super fund? It is a really kind of detailed episode, but it's all the basics that maybe you didn't know and just didn't actually know where to find the information. So the answer is find it in How Do They Afford That? The new episode out today. I'll put a link in today's show notes and you can find that one wherever you listen to podcasts as well. Thank you very much, Jen.
Thanks so much, Michael.
It is Wednesday, the 20th of September, 2023. Make sure you're following the podcast and join us online on LinkedIn, Instagram, X, and Facebook. I'm Michael Thompson, and that was Fear and Greed Business News. Have a great day.